Well, if you want the embodiment of what the four filters of the four lenses that we use to think about investments, and you open the book, it would be the picture of Berkshire there. So each of those four filters, first off, a good business that earns good returns on capital without using too much debt to do it. So if you look at the returns on capital that Berkshire has earned in the various businesses they've been in for a long period of time, they are very good. And they've spoken and written and acted in such a way that they've talked about, it's not that debt is wrong or there's any moral dimension to it. And it's not that they don't use some debt, but they use very little and comparatively less than most other people would in the same situation or circumstances. And the reason for that is debt introduces fragility into the system. That you might be very good at what you do, you may have a fine business, but if you have an interest bill that comes due at an inopportune time, you may lose the opportunity to continue playing your infinite game. So step number one, good business, good returns on capital without too much debt. Check, check, check. Lens number two is management teams with equal measures of talent and integrity. And so many of these lenses, I did not make these up myself. I learned them from people like Buffett and Munger and so many others. But if you look at how they have behaved over so many years, clearly the returns on capital that Berkshire's own suggests the talent that they have and the talent that is embedded within the entire system of Berkshire and the behavior, the personal integrity. They've always given the shareholders an epically good deal in terms of their cut. They've made the vast majority of their wealth through owning Berkshire shares and enjoying the exact same economics as what a shareholder does. It's not economics that they would have earned as managers rather than shareholders. So that's the test there. Point number three, and this is really where Berkshire has distinguished itself and in so many ways set the role model and the example. What we're trying to do at Markel is, does the business have capital discipline, and can they find acquisitions to reinvest the cash they make, or have capital discipline in terms of being good at acquisitions or share repurchases or dividend payments? Well, Berkshire had a tiny business 50 years ago, and they made money. And up until within the last year or two, they had taken on the challenge of reinvesting that money in their existing businesses or new businesses through acquisitions. So if you think about an Olympic diver, and you're judged not only in how well you execute the dive, but the degree of difficulty of that dive. So if you have a very good business and it makes excellent returns, but you pay the money out in dividends or share repurchases on a pretty regular basis, well, what you're doing is a dive of only a certain degree of difficulty. If you take it's a swan dive and you can do it and get a 10.0, but if it's just a swan dive, you will only get but so high a score because the degree of difficulty involved in doing that is not as much as when you introduce the triple axel, reverse, lunge, twist kind of dives. Those dives are harder to do, and to execute them well and with the same degree of precision that you can execute a swan dive, that's how you become an Olympic champion. And if you look at Berkshire's behavior and execution of an incredibly difficult dive for 30, 40, 50, 60 years, that's what makes Berkshire special, is that reinvestment lens and that reinvestment aspect, the third leg there. And then the fourth, and it's really the least important, is price discipline. Can you buy this at such a price that the returns of the business itself are going to roughly match what you as a shareholder receive? And that just means don't pay so ridiculous a high price when you find those three things, that the fault is yours in your execution of the purchase decision rather than what intrinsically happened at the business itself. Now, here's where the advantage of being part of the structure at Markel is so helpful. I spend the vast majority of my time on seeing whether those first three lenses are there. And if they are, and even if I conclude that this thing is way overpriced, I usually make myself buy just a little bit of it. And then 3 months or 6 months go by and I sort of revisit my thesis and I think about whether those first three factors are still there. And if they're there in strength, I make myself buy a little bit more. And then sometimes there'll be extreme dislocations in the markets, or for some reason or another, the price will change. Well, by virtue of already owning a little bit and making myself familiar with it, it emboldens me psychologically to take a bigger swing when something like that comes along. And even if it never gets to the point where you think, wow, this is an incredible price, but you keep thinking this is incredible business, if you find yourself buying it every quarter for year after year after year, and you're right about your underwriting decision on those first three aspects, you end up with a spectacular investment because the price you pay gets overtaken and swamped by the quality of the business itself.